to the Roundup, covering what's important to accountants and advisors across the month of November. Inside this month, a curious case of the taxpayer who claimed a loss on the main residence. The ATO's new client-to-agent linking protocols, I'm sure you're all loving those. But first up, more on the Bendel case. Michael, have there been any further developments since the AAT's decision in the Bendel case on whether unpaid distributions are loans for Div 7A purposes?
Yes, there have been some developments this month. Look, last month we talked about the Bendel decision, and effectively the tribunal basically held that unpaid entitlements owed to a corporate beneficiary should not be treated as loans for Division 7A purposes, and that goes directly against the ATO's approach in this area over the last probably 10 to 15 years, really. Since that time, there's been two things that have occurred. First thing is that the ATO has now appealed the decision. So the ATO is seeking to appeal the decision to the federal court. At this stage, we're not yet sure whether that appeal will be held by a single judge of the federal court or will it go to the full federal court. We'll just wait and see how that plays out. Now, it could take some time for this to occur. We could be talking mid to late next year before we actually see something from the federal court. So look, don't hold your breath. This is something that's going to take a little while to play out, but of course we'll keep you up to date as we see further developments. Well, the other thing that has occurred since we talked last month was that the ATO has released a decision impact statement in relation to the tribunal's decision. And this is an interim statement. The ATO wouldn't necessarily normally release a decision impact statement at this stage of the process. But the ATO, I'm assuming, felt that given the importance of this issue and the sort of ripples that it's causing out there in the community, that it was important to say something. Basically what the ATO has said is, look, they understand the AAT decision, but because they've appealed the decision to the federal court, they're not going to be changing the way they approach this area in the short term. They're going to continue to apply Division 7A in accordance with existing ATO guidance until the federal court hands down a decision, in which case the ATO will presumably revisit, depending on how that decision plays out. So it means that the ATO is not going to be kind of changing the way that it administers Division 7A. If you ask for a private ruling in this area, you can expect the ATO to continue to apply the rules as the ATO guidance has suggested for the last 10 to 15 years. Now, what it also means is if you have objections outstanding with the ATO, so if you have objected against an assessment which relates to this area, the ATO has said that they will basically put a pause on completing and giving those objection decisions back to taxpayers, again, waiting until the federal court hands down its decision. Now, having said that, as a taxpayer, you can kind of force the ATO's hand a little bit if you really want to. You could basically take steps to basically force the ATO to make that objection decision. But the ATO has said, look, if you do that, the ATO is simply going to apply the existing guidance. So the objection will probably be unfavourable to taxpayer if you're trying to get out of a Division 7A issue relating to unpaid present entitlements. So for the meantime, the ATO is not going to change the way it approaches Division 7A in this area. You can expect the ATO to continue to treat unpaid present entitlements owed to corporate beneficiaries as if they were loans for Division 7A purposes, and the ATO is going to stick to that view until we get a decision from the federal court.
So has the ATO flagged any other tax issues in connection with this decision?
Yeah, so the ATO decision impact statement, look, it focuses on the fact that the ATO will continue to apply the tax rules in accordance with existing guidance. But there is a bit of a throwaway comment in that decision impact statement alluding to Section 100A. Section 100A, that provision that a lot of us have been thinking about a lot more over the last 2 or 3 years than maybe what we had in the past. Again, just a refresher, Section 100A, it's the reimbursement agreement rules, which basically deals with situations where income is appointed to a beneficiary, but the real benefit of the funds, the money, is provided to another party, including the trust that appointed the income. Many of you will be aware that the ATO has issued some practical compliance guidance in connection with Section 100A, setting out kind of different risk levels. So arrangements that might be treated as low risk from a Section 100A point of view and arrangements that would be treated as high risk. Now, if you have a look back through that guidance, you'll see that some of the green zone scenarios, some of those low risk scenarios, particularly around distributions to corporate beneficiaries, make reference to the fact that there's an expectation that those distributions owed to corporate beneficiaries, particularly if they're outstanding for more than 2 years, will be placed under a complying Division 7A loan agreement. I think what the ATO is getting at here, and we could be wrong, is that if it turns out that their view around Division 7A is incorrect, so the federal court basically sticks with the taxpayer and holds consistent with the tribunal that unpaid present entitlements are not loans for Division 7A purposes, I think the ATO is flagging that, look, it doesn't necessarily mean you don't have a problem as a taxpayer if you appoint income to a corporate beneficiary and you don't satisfy that obligation within a relatively short period of time. It seems like the ATO is suggesting, look, if we lose on the Division 7A case, look, we're going to look at Section 100A. That's still on the table, and that's still a provision that could potentially apply in some of those scenarios. So look, I think just be a little bit careful about getting too carried away and excited by the tribunal's decision. First of all, it might be overturned. Secondly, who knows what the government will decide to do. The government may change the legislation to kind of fix that up in accordance with ATO existing guidance. Or you might find that the ATO simply says, look, that tool in our toolbox has been taken away from us. We've got other tools we could use. We could use Section 100A. Maybe Part 4A becomes a bit of a live issue as well. So we need to be very careful in this area. Again, we're going to wait and see what happens. We'll certainly keep you up to date with any developments, but don't assume that even if the ATO loses the Division 7A case, that they've got nothing left up their sleeves.
And from the ATO this month, the ATO now require additional steps when a new client comes on board. Matthew, can you tell us about the client-to-agent linking requirements?
Certainly. Some of us might be aware that the ATO brought out a process, this nomination process, this client-to-agent linking process. That's what the ATO is calling it. And I say some of us might be aware because this process previously, at least for the last year or so, only applied to certain taxpayers. Taxpayers in the public and multinational group space, certain large private client groups. Now, effective from the 13th of November 2023, so really midway through this month, the ATO has rolled out this process more broadly for all taxpayers with an ABN, excluding individuals and sole traders. Now, this process is required when you're onboarding a new client or if you've been asked to represent an existing client for additional tax obligations. So, for example, if you've been preparing activity statements for a client and they've asked you to prepare their income tax returns, well, this process covers those situations as well. And these are really security steps, and they're being designed to try and improve the security of the ATO's online system. There is concern now, especially now, around things like fraud, identity theft. And these steps, they're designed to mitigate, or I guess protect against that risk. And what it essentially is that clients will now need to log into their online services for business and nominate you as their agent using your registered agent number. You then have 28 days to log into your software, your practice software, to add them to your client list. Now, sounds simple enough, but the feedback is that this process is actually a bit fiddly. For one, some agents seem to be inadvertently adding themselves onto the wrong client account. For example, if you've been asked to represent your client only for income tax and you're intending to add yourself only to the income tax account, some agents are inadvertently adding themselves to the activity statement account. That can be a problem because that kicks off any existing agents off that particular activity statement account. And that can be a problem because what that means is that the client will then need to redo this process and renominate not only you, but the other agent as well. And you certainly only want your clients doing this process once. Now look, the ATO does have some reasonably comprehensive guides for this process. There's a step-by-step guide that looks at things from both the agent's and the client's perspective, and there's also a reasonably detailed FAQ as well. If it's the first time going through this client-to-agent linking process, just not a bad idea to go online, have a read of these guides, just to familiarise yourself with how these steps are completed from both the agent and your end client's perspective.
Some of our Knowledge Shop members seem to be getting letters from the ATO about some of their clients who have kind of older tax debts that have kind of been left alone for a while. It seems like the ATO is doing something in that space. Can you tell us what seems to be going on there?
Yes, the ATO are sending letters to agents and clients around debts that have been put on hold. That's going to come as a surprise for many because these debts don't actually display as outstanding on a client's account. Look, you can find them if you specifically go looking under old transactions, but I suspect for many clients, they might not be aware that these debts exist, especially when these debts start to get a bit older. And what the ATO is saying is that these debts on hold, they're really just debts that the ATO have decided are uneconomical to pursue. The ATO haven't written them off, but they've decided that they're not going to actively try and recover it or collect on them. However, if the client is entitled to a tax refund, certainly the ATO are going to offset that refund against those outstanding liabilities. Now, I guess what I'm trying to say here is that if you've got clients that are expecting a refund, but they've received a letter, they're the subject of a letter, or they've got other outstanding tax liabilities, it's probably not a bad idea to just communicate with them and just reinforce the point that they might not receive their refund in full or even at all, depending on the amount of these other outstanding liabilities. Look, you certainly don't want your clients making plans around how they're going to spend a tax refund that they may not end up getting.
In cases this month, the AAT has released another controversial decision, this time relating to property transactions. Michael, what happened in this case?
Yeah, this is a very interesting decision, and we're still waiting to see whether it has, I guess, far-reaching implications for other taxpayers. Let me just quickly run you through the facts of what happened here. And this is the Bowerman case. It was an AAT decision very recently that looked at the sale of a property. It was a property that was sold at a loss. And look, to some extent, that in itself is a bit unusual because we're talking about property located in Sydney in recent years. But this was a property that was sold during COVID lockdown period, which partly explains probably why this property happened to be sold at a loss. This becomes relevant later when we start to figure out what the implications might be for other taxpayers. So the taxpayer effectively entered into a contract to buy a unit off the plan. Now that process was taking a bit longer than expected. Taxpayer was notified that there was going to be a delay in, I guess, the construction of that unit. And so in the meantime, the taxpayer decided to buy another unit in roughly the same complex, but a different stage of that complex, and decided to live there. But the plan was to only hold on to that unit for a relatively short period of time, basically until their preferred new dwelling finished construction. They were going to then sell this other unit and their old home to be able to kind of afford settlement on the off the plan purchase. So entered into a contract for unit 1. It wasn't ready yet, so acquired unit 2 with a plan to hold on to it for a relatively short period of time while unit 1 was still being built. Now, unit 2 was used as the main residence of the taxpayer. So the taxpayer bought unit 2, moved into it, lived in it the entire time. Then sold the unit 2 or 3 years later, and as I mentioned earlier, sold it at a loss. The taxpayer claimed a deduction for that loss on revenue account to reduce their assessable income on the basis that they had made a loss from the sale of a property that was acquired as part of a profit-making undertaking or transaction. Now, you might not be surprised to find out that the ATO didn't like that treatment and argued that no loss should be available for the sale of that unit. First of all, that this was a property that was basically held on capital account. If so, the main residence exemption would basically operate to wipe out any capital gain or capital loss that was made on the sale. That this was a private transaction, so even if it was on revenue account, private and domestic in nature, that would eliminate that deduction from being available. And failing all of that, the ATO said, well, the loss was claimed in the wrong year. The taxpayer claimed the loss in the year the contract was entered into, and if there was a loss that could be claimed as a deduction, it should have been claimed in a later year when settlement occurred. So there's a whole bunch of things that the ATO didn't like about the treatment. Well, this ended up before the AAT. The AAT found for the taxpayer. The AAT found that this person had acquired Unit 2 with the intention of making a profit on sale in the relative short term. This was not a unit that this person was planning to hold on to for the long term. It was an interim purchase that they hoped would increase in value over the period of time that they held it. So this was not a long-term investment. It wasn't a long-term rental property, not a long-term home. It was a short-term capital purchase or asset purchase that would hopefully be sold at a profit in the relative short term as well. And the AAT was convinced that that was one of the reasons why the taxpayer bought the property. Interestingly, the AAT said it didn't need to be the only reason, just needed to be one of the reasons, that there was a profit-making intention. The AAT also had to consider whether this entire arrangement had a commercial or business-like feel about it. The tribunal was convinced that there was a flavour of a commercial transaction here. Again, it didn't need to be the only or the main reason for entering into the arrangement, but there was enough of a flavour of a commercial or business-like transaction here that put this on revenue account. The tribunal said the fact that the taxpayer lived in the unit the whole time didn't make this a loss or outgoing that was private or domestic in nature. The fact that it had been bought with the intention of making a profit in the short term meant that it wasn't carved out of the deduction rules on the basis of being private or domestic. Really interesting kind of approach to that area. So the AAT was convinced that a loss was made. It related to an asset that was acquired with the intention of selling at a profit in the short term, and the fact that the taxpayer lived in the property the whole time was not enough to exclude it from being deductible. Now, when it came to the timing issue, this one is also a little bit difficult to get your head around. The tribunal said that if they had to decide when that loss should be recognised, well, based on previous guidance and precedents in this area, that loss should be recognised in the year in which settlement occurred. But the taxpayer recognised the loss in the year the contract was entered into. The AAT said that that was okay in this case because the taxpayer had relied on an ATO ruling. So even though it was technically wrong, the AAT said it was okay for the taxpayer to continue to claim that loss in that year that the contract was entered into because they had relied on a public ruling that the ATO had published. Really interesting, again, conclusion that the AAT reached on that particular point. Basically saying that it's wrong, but we can continue to apply it because it relates back to an ATO ruling. Interestingly, that ATO ruling, I'm not sure, talks about property development, doesn't talk about scenarios like this, but the AAT said the taxpayer had genuinely relied on it, therefore the treatment should stand. So there's a bit going on there, and again, the important thing to note here is that this is someone who bought a unit, lived in it the whole time, sold it at a loss, and the ATO has said it's fine to claim as a deduction.
So is this a decision we should be celebrating, or should we be worried about this?
That's a really good question, and I think it depends on your situation. The taxpayer will definitely be celebrating that decision. They've been able to claim a significant deduction on the sale of an asset that was used 100% for private purposes. So I'm pretty sure the taxpayer is going to be pretty happy with that outcome. Of course, pending any appeal from the ATO, which we're not sure about just yet. For most other people, this is a little bit concerning because most people, when they sell property, make a gain, not a loss, just generally across the board. So if you're someone who has bought a property and you have used it for private purposes, you've maybe used it as a rental property, you might have used it as business premises, and you have sold that property within, I guess, the relatively short term, does this now mean there's a risk that any profit on sale will get picked up on revenue account? Profits on sale of property that are picked up on revenue account don't qualify for the main residence exemption, don't qualify for the general CGT discount, don't qualify for the small business CGT concessions, and we would also have problems applying certain forms of rollover relief. Capital losses can't be applied. This raises some pretty significant issues. There's potentially flow-on impact into even maybe the GST space. The way you calculate your GST turnover can sometimes depend on whether you're selling a capital asset or an asset that's held on revenue account. So there are some aspects of this decision which would be concerning to those who are selling property at a profit, which is most people. Now, again, it remains to be seen what the ATO does with this decision. You could kind of see from the ATO's perspective that this case itself represents a loss. It certainly goes against what the ATO's position was. But on a wider level, it might be tempting for the ATO to kind of leave this alone and start to apply a similar sort of reasoning as the tribunal when they come across situations involving properties that are held for a relatively short period of time and are sold at a profit. And it's just one of those things that is just a little bit hard to reconcile. And I think it'll just take us a little while to get our heads around what do we do with this decision. Now, it's a tribunal decision, and no respect to the tribunal, but it doesn't carry the same sort of weight that a court decision does. So the ATO isn't bound to apply this. The ATO has a bit more flexibility than it might otherwise have if this was, say, a federal court decision. So again, it remains to be seen exactly what the ATO decides to do with a decision like this, which I think a lot of people are concerned about and slightly mystified by as well. Now, again, we'll let you know if we see any developments in this area, but it is something to be mindful of, something to be very careful of. It just increases the level of risk associated with profits and losses, but mainly profits that are generated on sale of property, particularly where that property hasn't been held for an extended, significant, long period of time. So it's just one of those things you just want to keep in the back of your mind as you're dealing with clients who are involved in property transactions, that we do have this decision sitting here, which potentially increases the risk of profits being taxed on revenue account. And I think we just have to appreciate that and factor that into the advice that we're providing to clients.
And that's the roundup for this month. Changes are constant in the profession, whether you're an accountant or an advisor. This is exactly what the Knowledge Shop membership helps you do. Stay on top of change and make those change meaningful inside your practice. We'd love to show you how we help thousands of accountants across the country every single day. Give the team a call or drop onto the website. We'd love to show you how we make a difference. We look forward to speaking to you soon.